It is July 3rd, 2025, and it's a little after 2:30 p.m. Mountain Time. I'm Tim Quast, and with me is Brian Wilson, market strategist, and we'll hope to do a live demo and discussion here. All right, Brian, over to you.
Yeah, thank you, Tim. Great to see everyone. We really appreciate it every week when we're able to get together with you guys. I've got 4 topics today. They won't take too long, and then Tim and I will kind of cover the what's ahead section. I wanted to start with just intraday trading. I'll go ahead and share my screen. I don't think I have anything open. I usually have about 52 screens open at any given time. So as you guys are aware, daily trading ideas, and just a review of how I treat them. I'll sort them by probability. Let me enlarge this. I'll sort them by probability at the beginning of the day, and then I will just drop those into a watch page. So I have my momentum portfolio, and then I have my low volatility portfolio, and I do a little bit of intraday trading, but like Tim, I tend to reserve my trading usually for the end of the day. And one question that we sometimes get addressed or kind of talk about is, well, how do you know which names to pick on a given day? And obviously you can see right away, I'm not going to pick CRDO. It's going to be above the entry range, so some of them automatically get excluded. But let me share an example with BP. So I picked this one up towards day's end. It's in our low volatility portfolio. I'm looking to make 1% or a little bit more than 1%, hopefully on Monday or so. The exercise that I will do when I'm picking up these names is, and I had it up for a second, but let me pull it up again. I'm going to look for news. So that's one of my first things that I'm going to do. I'm going to look for something that just stands out. Why is BP down by a little over 1% today? If I don't see anything that really stands out in terms of that, I'm going to go to the trading volumes, and there's different ways of doing this, but I just use Yahoo. So what I'm looking for is I'm looking for the normal volume. So it's normally trading about 12 million shares a day. Why am I looking for volume? It's just another way to kind of think through whether I should pick up the name or not. So let's say that normal volume is 12 million shares a day, and let's pretend that this was a full day trading, and at the end of the day, volume was 20 million shares, and it was down over 1%. Well, that's a little telling that there was really heavy volume and it was coming under pressure. If there's heavy volume and there's not a real good reason for it, sometimes I'll leave that one alone, because that one tells me that investors are sometimes tagging along as sellers, and sometimes you can see a continuation of that. Well, if you remember what I just showed you, normal volume about 11 million shares. We closed early today, but you can see volumes have been light recently. When shares are down on light volume, it usually tells me that it was just the machines taking shares lower. There's no guarantee with that, but that's usually what's occurring. So hopefully that makes sense. I'll look for news in the name. I'll check trading volumes. If there's nothing that catches my eye there, then I'll pick that one up at the end of the day. So I picked up BP today, and what else did I pick up? Forget which one I picked up now. SMCI. So I picked up one from momentum and one from low volatility. But once again, using the range, looking for anything exceptional that might, exclude it. I'm not spending 20 minutes on it. It's a 2-minute exercise. So that being said, let me give you guys a quick SPY update. And I mentioned part of this morning with the short covering that we've been seeing, and maybe I'll start with our report. This is a report on the investor relations side of the business, and I was looking at this morning and kind of looking at it at the same time as the S&P 500. But, look at this upside over the course of the last 7 or 8 trading days, just incredible upside. And as we've had those gains, look at the corresponding short volume. So essentially, when the gains started to accelerate, short volume started to decline at the same time. And I wrote about it this morning. It was very evident the behavior that was responsible. What you're looking at here, you're looking at the behavior that's above the zero axis, heavy passive investment influence. And here's the norms, or here's where passive money has been. Here's the norms. So just a lot of passive investment buying and short covering at the same time that's been driving the gains over the course of the last few days on the ETF side. Now, I wanted to share with you, and I'm going to go back to 2020 and 2025. And you've seen me do this exercise before. It continues to be the nearest comparative that I have. And it's you've heard me say it for the last 5 weeks probably, and it continues to work out this way. If you look at 2020 trading, here was SPY. Just as a reminder, the norms in a normal trading year, this is kind of what it looks like. SPY will spend most of its time at 5. You'll see little blips above it, sometimes below it, but it spends most of its time at neutral. This was 2020. This was 67% gains from market lows all the way to the end of the year. And you can see how it was just, knocking off tens with regularity. One other item to point out, look at the short volumes. They stayed very elevated. Remember, this is the ETF side, but short volumes stayed very elevated, did start to get covered a little bit later in the year. If you look at where we're at right now, so what's happening with SPY? Well, we're starting to hit those tens. We just started to move above neutral. We moved up to 6 yesterday, and there's that significant short covering that I mentioned in today's note. Short volumes had been exceptionally high for quite a long period of time. They're starting to get covered, and once again, I think that's probably ETF market makers that are doing that covering. If we look, let's do the same exercise, 2020 comparison, but let's do it in a different manner, looking at the S&P 500 itself. So here's 2020, and let me enlarge this so we can see that better. So 2020 trading, that was kind of what triggered everything. We continued to just have an exceptional run. I had mentioned this in a note last week. Even in the middle of this exceptional run, there were air pockets. There were periods of turbulence that we need to be aware of. 7% losses here, 10% losses here, 7% losses here. That's the risk, even if the market continues to run, that we're going to run into these little pockets. I don't remember what occurred here. Tim has an exceptional memory, but you can see that there was no big events.
Patently untrue. The exceptional memory part. What thing, Brian, are you pointing to?
Right here in June of 2020, you can see we were kind of in between options expirations and month end. So it wasn't expirations related or month end related. It was something else that triggered those declines. I'm not sure what it was. But the point here is that occasionally you can hit turbulence seemingly out of nowhere, right? These were predictable. That was month-end activity. And where was the other one? This was expirations. So those were a little bit more predictable in terms of that turbulence. If you look at where we're at right now, and enlarge this for you guys, second longest stretch above the red line that we've ever had, second greatest returns that we've ever had above the red line. This right here is more normal trading. In fact, it was a shorter time frame than we're usually at. We're just, we very quickly went above the red line, quickly retreated. And you can see we're getting close to those stretched conditions again. And there's that exceptional short covering, that we have been recently tracking. And Tim, I think I'm going to leave it there. So once again, this really started this year's rally. Once again, it was the second longest stretch we've ever seen with the second greatest returns. This is more what we normally will see. And, just as a reminder, we're approaching it again here in probably Monday or Tuesday, I would imagine.
Yeah. Okay. So thank you, Brian. Appreciate that. Brad, was it COVID? So the question is, and somebody sent me a note for the replays and asked if I would please repeat the question because they don't see it. Yeah. So Brad, you said June 2020, was that COVID related? Could be. I can't remember. I do know it's something I was going to talk about. It was right after one of the longest periods of sustained points where SPY closed above its intraday midpoint. I'll talk, all I will tell you is it more buying or more selling, and how long do those patterns go? It's something Brian and I have been talking about. So, in fact, today would match something that's only occurred. It's not a record, Brian. It's happened like a half a dozen times. There were a couple of times in 2017. There were a couple of times in 2020. That was pretty close to one of them. I'm looking at some data. So I don't remember what event might have triggered it, but I can certainly see that was a key. That's what was happening into it. Very similar to what's occurring now. But I'll come around to that. Whatever it was, there was a big drop there. So what I wanted to talk about first is, let me share my screen, is how, whatever ones, and I have it too, there are things that I think might happen and I'm wrong. And I've always said that if you try to predict what will occur, you will be rendered a fool. But the beautiful thing about the data to me, what you want is a data set that will reliably tell you what to expect. And frankly, the market has done exactly what the data did. If you go back here, when we dropped way below the green line, and Brian and I both levered heavily long into the market here because the data were below this green line. If it's hard to distinguish, it's right where my cursor is there. And then above the red line, as Brian said, really from April 24 to May 28, we were above the red line. Well, historically, you don't get gains above the red line. But so long as the demand stayed there, it assured us that we would get gains. I mean, it's not declining off of that. And then it really hasn't, if you're just taking a round number, it hasn't been negative since, and neither has the market. Now, and we can certainly see the contribution of the supply side, so I'm repeating some of the stuff that Brian said, but the data have told us what to expect. If we're above the red line and then the supply side drops right at options expirations, people are betting long, and that's probably what's going to occur. This, you would think, well, this would undermine the market, yet the demand side stayed very strong. As low as we got, the lowest we got was 4.5. Well, it rounds to 5. It got to, 4.9 here. That rounds to 5. And if we're at 5 and the supply side falls, the market's going to rise. That we haven't had any inflection point since here, really. We'll get one. It's gonna happen, but the data have been very reliable in telling us what to do. If they say be long, then be long. If they tell us, okay, everything's deteriorating, it's time to be short, if you short, then you want to be short. I always say we're going to do 3 things all the time. 1, use the daily trading ideas, makes it very easy to take short-term, low-risk gains. Do that. Use the bigger picture to manage longer range risk. Should we be more or less exposed to equities? I certainly think we're going to get to a point here where it would be wise to be less exposed. I'll talk about that in just a moment. And there are those inflection points. peaks where we all of a sudden the data changes. There's an inflection point where you can trade volatility. Points like this where we have a clear bottom where you can put money to work. And if we're doing all three of those things, short term, longer range risk management, and inflection points, we're going to outperform. You know, it gives you a great tactics and strategy all the time, which leads me into, I just thought I'd give you an update. You know, there are two reasons why we haven't launched these model portfolios. I've talked about them extensively. I said, well, you know, could we use the math to create a portfolio that would have a changing underlying basket? And there are two things. One's programming time. You know, I'm very disciplined. The engineers on this, I have them do this. I will come to them and say, so I'd like to do this thing, and they'll say, well, we're out of budget for that project this month. And I said, okay, well, we got to wait till next month. We're always following our budgets. We always do. So take some time. There are data entitlements that come into play behind some of these data. It's also like, you know, why haven't we made broad sentiment downloadable? It's one of the things I'm going to talk with our S&P Global rep about. It's like if data are downloadable, all of a sudden you get kicked into a different cost structure for data that we license. And we're going to license market data. We license GICS data for sector purposes. And how that data is used determines, you know, what we get charged. So I'm careful about those things. I don't want to all of a sudden have a 300% increase in the cost of the data because of some way that we're making it possible to use. So I've got to sort that out. Now, back to these portfolios. Here's the thing. It dovetails with how well these data work. There are 3 portfolios on this screen. I realize it's kind of hard to see, but I'll explain it. So there's SPY, this blue line. That's SPY. It's outperforming one of the two now. So then there are the 3 core portfolios are, number one, take 2. It's taking the momentum data and taking 2%. The only thing that we removed from it was a short volume requirement. And it's worked really well. It's like, well, we'll just eliminate that. Now, it might not work in the future. During this particular period of time, that's the yellow line. When the entire market was tanking in, the latter part of February into March and then bottoming into April, I mean, everything got hit because everybody's going to own the same stuff. We're not going to own something that somebody else doesn't in a model portfolio. We're merely going to buy and sell them at different times. And I have the portfolios, but I want to get this point across. So during that period of time, this thing sharply outperformed SPY. The other two are quite similar. I say this is the buy fives portfolio. All it's doing is using the low volatility principles to build a portfolio of 35 stocks, and it wants to sustain them at 5 with declining supply over and over. So, Brian, maybe you can find that.
Sure.
And then the blend is saying, okay, let's take both.
Oops. Tim, I think I muted you. Sorry.
Okay, there we go. Should be anyway, right? Am I back?
Yep, you're good.
Okay.
Uh-huh.
Okay, so these two are just going to take a momentum and low volatility blend and then buy on fives. It's really interesting to me that very consistently, this is year to date, so January through yesterday, these two are up just about 11%. So they've almost doubled up on SPY. That low volatility in a model portfolio has been much better at producing returns. And every day it will say, sell this stuff and buy this stuff. And it's just a handful, and it will reweight. The thing that I have been trying to resolve is there a point in time where you switch horses? So for instance, if the portfolio performance, here's a way to think about this. If I'm just looking at relative performance, you would say be in this take 2, no short all through this time, and about April options expirations, all of a sudden, the performance of this portfolio materially deteriorated. Sell that portfolio and shift to I would say the fives portfolio because it's very consistently better. This performance was skewed by Chewy. It's a quantitative model. We don't override it. It just does what it does, and it held Chewy right through earnings. Now we all doing it manually would look at that and go, probably don't want to be in Chewy when it's when it's got it's 10 out of 10 for 30 straight days. Right into earnings, probably it could deteriorate, and it did. So it harmed the portfolio performance here. But it's knowing when to shift. That's what you want to do. Okay, what point do you shift from one portfolio to the next? So when we have all that and all the associated issues with it sorted out, and we're on budget and on time, we will make those available. And what it does is it just gives you a portfolio. I'll look at this as an example. So if I go, so here's the portfolio June 30, and it would say sell Budweiser, buy now, and here's your current portfolio. And it would just give you, the entry price and the current price and the amount that you allocate to it. I mean, it's a model portfolio, and there's the performance as of that point in time, up 11%. So we'll get to those. We just, it just, everything takes time. Everything always takes a while. Last, I want to talk a little bit about SPY because Brian and I were discussing this. So here's a fascinating fact that it explains many things about the performance of the market. I learn new stuff all the time. There's a lot we know about market structure. But so I was looking at how frequently over the entire data set, SPY closes above its intraday midpoint versus below. I mean, if you were saying, well, stocks go up because there are more buyers than sellers, and they go down because there are more sellers than buyers, it's not really true. We've explained how the market doesn't really work that way. There are intermediaries who foster liquidity. So the math shows that from over the data set goes back to July 2017. So, it's only 8 years. Was that material? Well, it's the data set we've got. That's apples to apples. Over that time, SPY has closed above its intraday midpoint 70% of the time. Now, how would it be possible for buying to be 2/3 of the market and selling 1/3? Where would the supply come from? If I'm buying a stock, the stock I'm buying has to come from somebody or some place, right? It doesn't just magically appear, except it does, as we've explained. If buying outranks selling by 2 to 1, the market would be violently volatile. I mean, how would you induce someone to sell something to you? If I want to buy something and there are no sellers, how can I buy it? Well, the SPY explains this, and it also explains why the market behaves the way it does. We've explained that a lot of what happens in the market is this. It's short volume, which is basically artificial liquidity. If there are no sellers, how do you fill a marketable trade? Well, Citadel comes along and provides it to you. Now, on its value at risk, it has exposure short to and it's got to keep track of thousands upon thousands of things simultaneously, and they want to be zero exposed all the time. So what we're seeing is the unwinding of that. But that explains how the SPY can go up 2 out of every 3 days if you're using how it performs versus midpoint as the best read. But what that means is at some point it tears. That's what happens, and you see it happen. That you have a great run, boom, because you cannot have relentless buying with no selling. Sooner or later, the value at risk has to be squared, and frequently it's a form of inflation. I've explained that the stock market behaves more like a currency market anymore because of ETFs than it does an equity market. There are relative values. And if you continually increase the supply of currency, everything goes up until a point at which all the currency is Gresham's law. Bad money has chased out good. All the assets have consumed that supply, and then everything has to reset. Now, I don't know what's going to happen, but I've said these conditions are really unusual. So today would be 9 straight days that SPY closed above its intraday midpoint. It's happened half a dozen, five, I think, times before, and it has preceded big ruptures in the market. Doesn't may not be the next day or two. It's you don't know when that's going to happen, but it helps explain how the market works. And you may be baffled, and I can make it simpler, but it all comes back to all of these things are observable. Any condition that lasts a very long time, one direction will necessarily have to have an offset because there isn't enough liquidity for things to continue to do what they're doing. Now, I don't know where that's going to be. And that will bring us around to wrapping this thing up and talking about what's next. Look, I take what the data give too. There are times when I have an expectation. Maybe the expectation is realized as it was December 18 and as it was in February. Inflection points where we could go, that's going to happen. In this period of time, clearly the data say be long. So we're long. But I also think, again, we're going to come to the end of that. Is it a rupture? I don't know, but I can tell you something that we'll want to look at. What do we always say? Look at context. So what's the next thing on the docket? And it's both options expirations. So that'll be, the next time is middle of July. We'll see what happens. It could be July 9. Could be a very important day. It will be the end of the 90-day moratorium on tariffs. Now we have these tradable events. Tariffs are a big factor in how people bet. Machines execute the trades. So we'll see. I've also noted that when there has been a very extended decline on the supply side, and you can go back and look at it, pull up the entire broad sentiment data set and go back and look at points in time historically where there has been a steep retreat on the supply side. It is almost always followed by a spike up and a sharp drop in the market. I don't know that that's going to happen. We just want to make sure that you're aware of what's occurring, and so that you can, the prudent foresee evil and hide themselves. So what happens next? I don't know. We'll watch the data. So long as the data say positive, it's probably positive, but there are things that are about to change. If you count the number of days here, 1, 2, 3, 4, 5, 6, 7, 8, 9, it's not unusual, but that's at the very outside length of the tendency of these moves. There was a very long move up here and a pretty long move down here, very long move up, pretty long move down. They're predictable. These things all move in patterns. Just like how long do you go closing above the intraday midpoint? Never has it gone more than 9 days. Well, Monday would be 10. What's the probability? I don't know. The probability would be it's a down day, but that doesn't mean it will happen. Anyway, these are all things that we think about. And in terms of what's next, I can only tell you we will watch the data. I think that we're coming to the end of a very, very long, this has been a very unusual period. The whole year has been unusual from a market structure standpoint. But again, we'll just see what the data give us. I can tell you the daily read is now 6.3. It's over the red line. Again, that doesn't mean anything based on what has happened since April 24. Brian, what do you see?
Yeah, thanks, Tim. I'll go ahead and share my screen. It's actually very similar to you, and then there's a couple questions to discuss. Maybe you can look at a couple of those while I'm sharing my screen. And actually, I'll start with one of the questions since I have it up. Candace, I think this is what you were referencing, and I just pulled up an example. So Candace had a question in terms of she got stopped out of a couple positions. I don't think it was Tesla. I just pulled this up as an example. What she was noticing in the ones that she got stopped out of was declining demand and declining short volume. Declining sentiment, well, that speaks to declining demand. When demand is decreasing at the same time as short volume, sometimes what that will speak to is just natural sell interest on the other side. So in other words, short volume is a representation of borrowed shares. So shares are being borrowed as a normal way of trading. Every single equity has their norms. The broad market has their norms, et cetera. But when you see declining demand and declining short volume, uh, sometimes there's not a need to borrow shares because every time a buyer pops up, there's a seller that fills it. So, in other words, there's just not that need for the normal borrowing that you would see in the marketplace. And Candace, hopefully that makes sense. I see it over and over again on the investor relations side that sometimes it just speaks to natural sell interest out there. And once again, there's not as much of a need to borrow shares because of those natural sellers. So hopefully that concept makes sense. In terms of what comes next, Tim mentioned a lot of it. This run probably comes to an end fairly soon. Now, it didn't mean much the last time it came to an end. We saw short volumes decreasing. They went back up, but since demand was so strong, we never really declined very much. It just kept us chugging along. And I think a big part of it here playing out in the next week or so will rest on the demand side of the equation. Once again, we're approaching that stretched sentiment, normal gains across the market. When we move through the red line to when we go back through it over the last 5 years, it's 50 basis points, 60 basis points. So gains really disappeared. And this is a perfect example. You can see how the whole market just kind of came to a pause there for a period of time. And then you kind of assess what's next. So that to me is my look ahead, is the fact that we are approaching stretched sentiment. Now we're increasing pretty rapidly right now. I had actually bought a leveraged long instrument. It was yesterday. I just sold it today because I made 3% on it. I bought it because sentiment was increasing at a very rapid rate. It kind of communicated that we would probably continue to move higher. There's no guarantees with that, but that was my rationale for the trade. And once again, that's what I think is ahead, is watching this stretched sentiment, but really watching what's going to be happening on the demand side. And Chris, I think you had a question, and if you want to go ahead.
Yeah. Hey, thanks. Good information. I was just curious, I'm wondering, is there a way we can track ETF data? Because you've talked about the tail wagging the dog a little bit in this case, and I was wondering if this is something you're looking into.
I only caught part of that because I can do 80% of one thing at a time. I was replying to Candace's question. So I think you said, where can you get ETF data? We have it. We just, if we put it on the platform, it would distort all the demand supply signals. What my best answer to that is that to understand ETFs, follow the underlying asset data. There have absolutely been disconnects. I wrote that I think we reached a tipping point during the pandemic for the effects of ETFs. I mean, we always wonder, is there a point at which arbitrage becomes more powerful than the underlying purpose? Are you putting money to work because you think there's a growth opportunity or a value opportunity? Or are the prices principally reflecting an arbitrage trade? And that's why I get to that, 2 out of every 3 times, 2 out of every 3 days, SPY closes above its intraday midpoint. That doesn't mean it closes, the price is higher or lower, but it's a great signal of whether there's buying or selling. And so what do you do with ETFs? It's still got to come back. That they got to come back to the underlying asset. They're like asset-backed currencies. There is a basket of equities and an ETF that is going to reflect that performance. And far and away, the biggest thing, I've had a conversation, I think I shared this, with 2 ETF platforms that will do everything for you, all the regulatory compliance. There are a lot of things that you have to do if you're running an ETF. And they said 90% of ETF assets are in large cap blend equities. They're large caps. That's why we put all of our focus, we say small caps are difficult, 5% of assets. I ran a focus momentum portfolio. It did great, but you can't get in and out of them. I mean, it was up 50%, but if you one thing, you can't get in and out of those stocks. So there go all your returns. So to understand ETF performance, I always come back to large caps. They will always tell us. Fact, let me just offer this, and I'm deviating from your core question, but I found it to be very interesting. If we always come back to broad sentiment because SPY or S&P the S&P 500 is 90% of market cap, but you could do a Dow Jones Industrials. You just do it manually. I built a manual DJIA portfolio by putting the 30 tickers in. They're easy to find. And you look at that, 6.7, and supply is already turning. So the Dow performed better because it was underperforming the S&P 500 and the NASDAQ. But that's a turn. Again, you come back to those are large caps. And you look at the mega cap portfolio, which again, all you have to do is go in and put mega cap in your portfolio criteria, 100 billion or more in market cap, and it's they're at 6.6. Well, it's 126 of them now. Every time the market goes up, sometimes the refresh will trigger that. So that number keeps rising. It was 119 prior to to December 31. Now it's 126 when the demand's strong. So the big keep getting bigger, and it's topped right 6.6, and supply has bottomed. And I don't know what it's going to do. But it continues to be a great way to understand which way the market goes. Whatever else is happening in this area or that area of the marketplace, the mega caps matter. I have this little safety portfolio. It's manual. There are 7 companies in it that have performed well in 2025. And so I just use it as a statistical sample. It is not meaningful, but look at them too. So the supply side is starting to rise again. And these are the ones in it. Look at how large they are. The smallest one is 3M at 83 billion in market cap. So they tend look at this. Look at the supply side. It's all down, and they're mainly 5. Because that's their 5s. They should be. But you could always come back to the large caps, and it will tell you what most of the money is doing, including the ETFs. We look at that data all the time. You could take. Pick a stock. NVIDIA's in over 800 ETFs, and it's in small cap, mid cap, and large cap. There aren't enough equities. So the basket that is being constituted for these ETFs, there is immense overlap. You can't have 4,000 ETFs trading in the U.S. market. We're pretty close to that. 2,000 of them predicated on underlying equities when 126 stocks are 70% of market cap. Everybody's going to have the same stuff in the basket. So that's what I always come back to. All right, Brian?
Yeah, thank you, Tim.
Yeah, did that answer the question, though, or did I not? I'm not sure.
It's a partial answer. It's a good answer. So thank you.
ETFs, no matter what, even if they're the tail wagging the dog, are always dependent on the underlying equities, just as my problem with what's happening with cryptocurrencies, being a student of history, is we're seeing something that has happened down through history. James Madison wrote in the Federalist Papers about the pestilent effects of paper money, meaning all these banks is why we established a central currency authority called Congress. That if you have all hundreds of banks and they issue scrip, and that scrip becomes a currency. And that currency gets spent building railroads or whatever. And then railroads are overbuilt and the railroad builders go broke. Then so does the bank and all the people associated with the bank. So in some ways, cryptocurrencies are a modern manifestation of that. I'm not knocking them. I'm not saying there's anything wrong, but you have to think about them as historical comparatives. And so are ETFs. It is, okay, can you take Bitcoin, which has a finite quantity of digital whatever it is underpinning it. Now, what happens when you create ETFs that track Bitcoin? Well, you've just expanded the access to it. What if you now create stable coins or staked tokens that are associated with that? That is all currency devaluation. You're expanding access to a finite asset. This is exactly what ETFs do to the equity market. They expand access to what is actually a shrinking pie. We've had a lot of SPACs. scads of them this year. We have all kinds of tiny little Chinese IPOs. But if you look at large caps, more large caps are going away by acquisition than are coming public. And as public companies continue to consume their own equity with buybacks, $1 trillion a year, and we continue to increase the supply of ETFs, what you get is an SPY that goes up 2 out of 3 days. But at some point, it all resets. That is the pestilent effect. I don't know where that manifests, but it's, Jamie Dimon said this about the bond market. He said, it's going to crack. I can't tell you if it's 6 months or 6 years, but I can look at the mechanics of all of this and say, that's going to break. But, the good news is we can see the demand supply. We saw what contributed to this great run from April, right? What did it? Immense increases in artificial liquidity. And then that has to be consumed. It's been consumed. So two things created this great run for the market. It wasn't a huge increase in inflows. It was a massive increase in currency and then an effort to square the books on that currency. Now, what happens when that's over? I don't know. We'll just watch the data. But all of these things that I'm telling you, it's all true, right? These are all things, if one looks at the mechanics of the market, are observable. It's just that most people don't observe it. So I'm not scared or worried about it, but I look at it and say, we should be watching that, right? At any inflection, any turning point in those data, and by those data, what do we mean? We just always come back to demand and supply. What is that demand-supply relationship doing? SPY as a great read, just a read on the ETF complex. It is a type, and it's very large, so it's a great type to tell us what to expect. And you look at this and go, well, I mean, it's really, it's impressive that it's value and growth. It is large cap blend all the time at 5, as Brian said. We had this rupture and we're going to have another one. I just don't know when it's going to happen. We had one here and this was the second one, right? So it'll happen. There will be fluctuations on the demand and supply side that will be tells. And we just look for those, and we trade the daily trading ideas. We try to take a long range look at the risk. If there are inflection points, we're going to take advantage of them. And that's the best I can tell you.
Yeah, that's great info. Thank you.
Betcha.
There was one comment from Martin, and maybe it's just, a thought. He was asking whether there's a way to share portfolios between market structure members, like sharing a playlist or what have you, almost kind of like a Reddit group, perhaps. So just maybe something for consideration.
Next time. We can think about it. Yeah, I took you longer with my comments. I meant to get you out of here earlier. We could. I mean, is it possible? Well, of course it is. Technologically, it is. One would have to. It's like eToro is doing that. Like you can go track. You can follow traders you like and do the same thing they do. I think Webull is doing something like that. Behind the scenes, we could just have to weigh the merits of it. All right. Well, that was longer than we should have taken you right ahead of the 4th of July. Have a great 4th of July, everybody.